You are probably incredibly used to the daily noise of crypto tickers.
Oh, yeah, the constant flashing red and green on the screens.
Right. The endless chatter on social media, the minute-by-minute price updates on your phone.
It can be entirely exhausting to track.
It really can. But today's deep dive into the March 10th, 2026 Bitcoin News Digest is, well, it's different. We are looking at massive structural shifts that are all converging at this exact moment in time.
Yeah, creating a macro environment we haven't quite seen before. Today is really about stepping back from that daily screen staring to look at the underlying mechanics driving the tape.
Exactly.
We are examining real-time market data, network metrics, and geopolitical reports. And just to set the parameters right off the bat, we are observing these events through a strictly neutral, objective lens.
Right. Our goal isn't to take sides on the political stage or endorse any specific administration's action.
No, not at all. We're simply looking at the data to understand exactly why the market is reacting the way it is today.
Which brings us to our mission for this deep dive. We're going to unpack the intersection of Bitcoin's terminal scarcity.
A huge factor right now.
Yeah, a major Wall Street infrastructure upgrade that just went live, and the highly volatile geopolitical forces driving the market.
It's a lot converging at once.
It is. Okay, let's unpack this. We have to start with the milestone that hit the tape yesterday.
Block 939,999.
That's the one, mined by the Foundry USA pool. At that exact block, the network issued its 20 millionth coin.
Which is just a massive psychological and mathematical threshold to cross. I mean, everyone tracking the space knows the hard cap is 21 million.
Right.
But crossing the 20 million mark means that 95.2% of the total supply is now out there. It's circulating or stored.
We have officially entered the terminal scarcity phase.
Exactly. There are fewer than 1 million coins left to be mined, and under the protocol's mathematical schedule, it'll take another 114 years.
Until the year 2140.
Yeah, until 2140 to issue that final 4.8%.
But, looking at that 20 million number in a vacuum feels a bit like a mirage.
It does.
When we look at the network metrics, what is the actual tradable supply looking like right now?
Well, when we dive into the chain analytics, we have to isolate what's called the liquid float. 20 million coins exist on the ledger, sure, but the true tradable supply is significantly lower.
Much lower.
Chainalysis data indicates that between 3 and 4 million coins are permanently lost.
We're talking about early miners who threw away hard drives.
Forgotten seed phrases.
Right, or early adopters who have passed away without passing on their private keys.
Those coins are cryptographically locked forever. So when you subtract those, the real float, the actual amount of Bitcoin interacting with the global economy, is roughly 16 million.
I want to push back on that slightly, or at least narrow the focus for the listener.
Sure.
Even that 16 million isn't just sitting out in the open waiting to be bought.
No, absolutely not.
When we look at the exchange depletion metrics, there are only 2.7 million Bitcoin left on centralized exchanges right now.
Multi-year low.
Right. So why should you care? If you are a macro allocator stepping in to buy, that 2.7 million is the only easily accessible inventory on the shelf.
What's fascinating here is the absolute inelasticity of that remaining supply. In traditional commodity markets, a massive price spike usually cures itself.
Because higher prices incentivize producers to flood the market.
Exactly. They flood it with more supply, which eventually cools the price down. But Bitcoin does not care about the spot price.
It really doesn't.
It doesn't matter if the price goes to 100,000, 500,000, or $1 million. The network will only ever issue exactly 450 new coins per day right now.
That emission is mathematically locked.
A higher price cannot trigger more production. So when massive demand hits a shrinking liquid float of 2.7 million coins brine.
And a locked emission schedule of 450 a day.
Right. The only release valve for that pressure is the price moving upward.
And we definitely saw that release valve trigger this week. The weekend price action was brutal.
Very brutal.
Testing a Monday low of $65,500. But then we saw an incredibly sharp 7% recovery to stabilize near $70,000.
Looking at the chart data right now, the current price is hovering around $70,530.
Yeah, and what stands out on the volume profiles is this exceptionally dense support floor established between $66,000 and $68,000.
With a massive line in the sand drawn right at $67,088.
Right. That $67,088 level is acting as a concrete floor.
But the catalyst for this specific recovery is what the market is calling the energy trigger. We have to look at the macro environment that was heavily suppressing risk assets.
Crude oil had spiked to $120 a barrel.
Because of the geopolitical tensions in the Middle East, that high oil price placed a massive inflation premium on the entire market.
It signaled that inflation would remain sticky.
Liquidity would remain tight, and risk assets would suffer.
But then the geopolitical narrative shifted abruptly, and crude oil collapsed.
Dropped from $120 all the way down below $89 a barrel.
The specific trigger for that drop was President Trump's comment to CBS News regarding the Middle East conflict.
Right.
He stated his belief that the war is, quote, very complete, pretty much.
And the moment the market digested that comment, the perceived risk to the global energy supply evaporated.
Yeah, that inflation premium was wiped out in a matter of hours.
The mechanical chain reaction that followed on the trading desks was violent. You have macro hedge funds that were heavily positioned for a worst-case energy scenario,
Holding massive short positions across risk assets.
including Bitcoin. Suddenly, the energy risk fades, oil plummets, and those funds are caught completely offsides,
They're forced to cover those shorts.
which means they have to market buy to exit their position.
And that forced mechanical buying is what violently pushed the price up through that $68,000 resistance level.
The moment it broke $68,000, it triggered a cascade of stop-loss orders from other short sellers.
Accelerating the run right back up to $70,000.
And we know exactly who was doing the heavy lifting during that short squeeze.
The definitive footprint is in the Coinbase Premium.
Exactly. For the first time in 40 days, Bitcoin is currently trading at a higher spot price on Coinbase than it is on offshore exchanges like Binance.
Which historically indicates a very specific type of buyer stepping into the market.
It confirms that U.S. institutions and domestic funds are the ones aggressively bidding up the price.
Because Coinbase is the primary venue for U.S. institutional flow.
Right. When the premium flips positive there, it tells us this isn't overseas retail speculators driving a highly leveraged momentum trade in Asia.
This is heavy, spot-driven, domestic institutional capital moving the market and absorbing that localized supply.
Here's where it gets really interesting. When we look at the U.S. spot ETF inflow data, mirroring that Coinbase Premium,
The numbers are staggering.
they really are. On March 9 alone, the U.S. spot ETF complex saw $167.68 million in net inflows,
With BlackRock's IBIT fund leading the charge.
pulling in $109.95 million of that total in a single trading day. Over the last 2 weeks, these ETFs have absorbed $1.35 billion.
That billion-dollar figure reveals the underlying psychology of the market right now.
We are seeing the concept of the strategic window play out in real time.
Professional allocators aren't panicking about the weekend volatility.
No, they are treating the $65K to $70 range as a definitive value zone. They are actively using the geopolitical uncertainty as an opportunity to accumulate,
They are looking past the short-term noise.
viewing this specific price bracket as a window to build their positions before the next major leg up.
And while those allocators are building positions, the actual plumbing of Wall Street just got a massive upgrade that completely changes the frictionless flow of capital.
This is huge.
Let's look at the infrastructure update that just hit the tape. Broadridge Financial, which trades on the New York Stock Exchange under the ticker BR, just integrated Crypto.com directly into its NYFX network.
The scale of capital this represents is monumental. NYFX isn't just another trading app.
It is the messaging backbone for Wall Street.
It is the central nervous system used for routing stock and bond trades globally. By integrating directly into this network, over 2,200 broker-dealers can now route Bitcoin buy and sell orders on the exact same terminals.
Using the exact same workflows that they use to trade traditional equities.
It's completely seamless. A broker doesn't have to log into a separate portal
Or manage different sets of credentials.
or navigate an unfamiliar user interface. Bitcoin is now just another ticker symbol on the screen they already stare at all day.
Which permanently removes the friction of having to use crypto-only platforms.
For years, the final excuse for large legacy asset managers to avoid this space was that the technical and regulatory friction was simply too high.
It was too difficult to route and settle the trades within their existing heavily regulated compliance frameworks.
But the Broadridge integration eliminates that technical barrier entirely. It provides a heavily regulated institutional-grade pipeline directly into the Bitcoin liquidity pool.
Now, if Wall Street is building these massive infrastructure pipelines for frictionless access to Bitcoin, it begs the question of what macroeconomic catalysts they are preparing for.
Which brings us to the volatile situation in the Middle East.
Right, and the geopolitical tail risk hanging over the markets right now. Again, to be clear for you listening, we are strictly looking at the facts on the ground and how markets are pricing them.
We have a very complex situation unfolding in Iran.
State media has started referring to the new supreme leader, Mojtaba Khamenei, by a very specific title.
The Janbaz of Ramadan.
Right, and the translation of Janbaz means someone who has been wounded by the enemy or who has sacrificed a limb.
And crucially, he hasn't been seen in public since February 28.
If we connect this to the bigger picture, the market implications of an incapacitated supreme leader are severe.
There are widespread reports suggesting he may have been injured during the initial strikes of Operation Epic Fury.
Or possibly in an internal incident.
Either way, the physical status of the supreme leader matters immensely to the global markets because it dictates who is actually making the strategic decisions.
If he is incapacitated, the Islamic Revolutionary Guard Corps, the IRGC, likely assumes de facto power.
And the market prices an IRGC-led government very differently than a traditional diplomatic channel.
Because a government effectively run by military hardliners drastically lowers the chance of a diplomatic resolution.
It increases the probability of a protracted, escalating conflict.
Mm-hmm.
And we've seen the U.S. response to this leadership shift.
President Trump has publicly called the selection of Mojtaba unacceptable.
And has promised to maintain continued military pressure.
So the market is pricing in the reality that this conflict is far from a clean resolution, despite the recent drop in crude oil prices.
Which brings us to the core economic question. What does this all mean for the debt loop back home?
Wars are incredibly expensive. The United States is currently spending an estimated $891 million per day on Operation Epic Fury.
Almost $1 billion a day.
And tomorrow, we get the new CPI print, which is expected to show inflation at 2.41% year over year. How does a geopolitical conflict on the other side of the world directly impact the U.S. Treasury, the Federal Reserve, and ultimately a fixed supply asset like Bitcoin?
It comes down to the mechanics of funding that $891 million daily burn rate. To maintain that level of massive expenditure, the U.S. Treasury has to issue new debt.
They have to continually sell bonds.
But the critical pivot point right now is that foreign demand for U.S. debt has been steadily dropping.
Foreign central banks and sovereign wealth funds aren't stepping up to absorb our debt issuance the way they historically have.
Exactly. If the Treasury is issuing massive amounts of new debt to fund Operation Epic Fury, and foreign buyers aren't absorbing it, the Federal Reserve will eventually be forced to step in as the buyer of last resort.
They will have to expand the M2 money supply to purchase those Treasury bonds.
And historically, when we look at periods of significant M2 expansion to fund government deficits, highly scarce fixed supply assets like Bitcoin tend to rally aggressively.
Because the market anticipates the currency debasement and moves capital into mathematically hard assets.
It is the perfect macroeconomic storm.
It really is. We have just crossed the 20 millionth coin threshold, meaning the supply is mathematically locked and entering terminal scarcity.
You have Wall Street gaining totally frictionless access to trade that dwindling supply via the NYMFX integration across 2,200 broker-dealers.
And you have a geopolitical environment that is forcing the U.S. government into massive ongoing debt issuance while foreign demand for that debt wanes.
It's a confluence of incredibly powerful macro forces converging all at once. For the immediate future, there are 3 actionable metrics the market is watching closely to see how this plays out.
What's the first one?
First is the price resistance level. Bitcoin needs a decisive daily close above $71,700 to confirm that this run back up to 70K is a permanent market structure.
And not just a temporary short squeeze bounce.
Right. Keep in mind, the ultimate chart resistance right now sits up at $74,434.
That's the technical level on the charts. What are the fundamental data points we need to track?
The second metric is tomorrow's CPI print. If we see a higher than expected inflation number, the market will likely react with a short-term drop.
Pricing in tighter liquidity.
Exactly. But if the number comes in low, confirming that 2.41% expectation, it will act as pure fuel for a move toward that 75K level.
And the third metric?
The third metric is those exchange reserves we discussed earlier. Watch that 2.7 million number closely.
Because if we see exchange reserves drop from 2.7 million down toward 2.5 million,
the probability of an acute violent supply shock becomes highly likely. The available inventory would just be too thin to handle the incoming institutional inflows.
It is genuinely fascinating to watch these macro pillars align in real time. And it leaves you with a critical question to ponder before we wrap up.
What's that?
If traditional legacy broker-dealers are now seamlessly routing Bitcoin orders right alongside their massive S&P 500 flows through the NYFX backbone, what actually happens to the traditional 60/40 portfolio models?
That's the million-dollar question.
When Wall Street's functionally infinite fiat demand collides with a mathematically unchangeable wall of just 450 new coins a day, something has to give.
And historically, it's the fiat denominator that breaks, not the protocol.
Thank you for joining us for this deep dive. See you next time.